Friends, this is Sahas Academy. We are presenting India Macro Market Analysis. It covers global and India-centric events impacting currencies, interest rates, equities and gold. This week's theme is Reserve Bank of India's Monetary Policy Committee decision. So, let's begin with episode 3. This week's theme is Reserve Bank of India's Monetary Policy Committee decision, so let's start. RBI's Monetary Policy Committee has decided unanimously to keep the policy rates unchanged, with this repo rates unchanged at 6.5%, SDF at 6.25% and MSF at 6.75%. Further, the MPC has also decided to continue to maintain stance of withdrawal of accommodation with a vote of 5-1 to ensure that inflation progressively aligns with the target, while supporting growth. RBI Governor insisted that headline inflation is projected at 5.1% in 2023 to 2024, which is lower from its level in 2022 to 2023 but would still be above the target of 4%, warranting continuous vigil. Hence, any future decision will be data-dependent. CPI inflation projections are lowered at 5.1% for 2023 to 2024 from April's forecast of 5.2%, with Q1 at 4.6%, Q2 at 5.2%, Q3 at 5.4% and Q4 at 5.2%, with risk evenly balanced. As per RBI, the progress of the southwest monsoon is critical for the inflation projections. Consumer confidence is improving, and businesses remain optimistic about the future. The cumulative rate hike of 250 basis points undertaken by the MPC is transmitting through the economy, and its fuller impact should keep inflationary pressures contained in the coming months. Real GDP growth for 2023 to 2024 is projected at 6.5%, with Q1 at 8.0%, Q2 at 6.5%, Q3 at 6.0%, and Q4 at 5.7%, with risks evenly balanced. As per RBI, domestic demand conditions remain supportive of growth, on the back of improving household consumption and investment activity. Urban demand remains resilient, with indicators such as passenger vehicle sales, domestic air passenger traffic, and credit cards outstanding posting double-digit expansion on a year-on-year basis in April. Rural demand is also on a revival path. The higher Rabi crop production in 2022 to 2023, the expected normal monsoon, and the sustained buoyancy in services should support private consumption and overall economic activity in the current year. The government's thrust on capital expenditure, moderation in commodity prices, and robust credit growth are expected to nurture investment activity. Weak external demand, geoeconomic fragmentation, and protracted geopolitical tensions, however, pose risks to the outlook. The surplus liquidity in the banking system on the back of government spending, FX flows, 2,000 rupees note bank, and transfer of dividend by RBI to government refrained RBI from change in stance. We expect RBI to maintain long pause in policy rates. Now, let's move to next section, global events and news. There is a strong expectation that Fed will keep interest rate on pause. Despite strong US non-farm payroll data that rose to 339K in May from 249K in the previous month, rise in unemployment rate that rose to 3.7% in May from 3.4% in the previous month put a lid to any rate hike expectation. These may be initial indication of cooling of job market. Further, a jump in U.S. jobless claims for week ended 3 June 2023 to the highest since October 2021 suggests the labor market is supporting initial sign of cooling job market. CPI data is important for the Fed to decide further course of action on rate fronts. CPI data is expected to show soft print due to low crude and commodity prices. However, core CPI is expected to see some spike due to large sale volume seen in used car market. Sticky core inflation warrants some rate action from the Fed to tame inflation. However, cooling job market and weak data from ISM manufacturing and services will put the Fed on wait and watch. Reserve Bank of Australia surprised the market by raising policy rates by 25 basis points to 4.1% and indicated that there would be more tightening needed to bring the inflation down to target levels. However, future rate action will be data dependent by assessing how the economy and inflation evolves. Meanwhile, Australia's GDP growth slowed to 1.5-year low of 0.2% quarter-on-quarter in the first quarter of 2023 versus estimated number of 0.3% and 0.5% in the previous quarter. Central Bank of Canada has also surprised the market by raising its key policy rates by 25 basis points to 4.75%. The decision was taken in the view to tame sticky inflation. Canadian Central Bank was on pause since January. The BOC said strong consumer spending, a rebound in demand for services, a pickup in housing activity, and a tight labor market contributed to its decision. The surprise rate hike by Canadian and Australian central banks has raised concern in the market that rate hike cycle is not yet over, though there is a pause. Similarly, Fed is expected to be on pause, but market expects if this time there is pause, then in the next meeting of July definitely there will be a rate hike. In Europe as well as in UK, services activity is seeing moderation, with market PMI index declining. As per European Central Bank Governing Council members, further interest rate increases are necessary to curb persistent inflation pressures across Europe, though the rapid decline in energy costs should help to tame inflation in Europe. There will also be a cooling in the increase in core inflation, which reflects the reduction in the cost of energy. The ECB president has acknowledged that the headline inflation is falling, but there is no clear evidence that underlying inflation has peaked. Slowdown in manufacturing sector in China that was indicated by soft producer price index in May, which came lower at 4.6% as reported by National Bureau of Statistics. Recent data points indicating slowdown in economic activities with weakening exports, imports and factory activities. In the month of May, the China's export fallen by -7.5% year-on-year from the previous month's number of +8.5% year-on-year. On the contrary, China's imports declined by 4.5% year-on-year, better than the consensus expectation of a -8% contraction and a marked improvement on the -7.9% fall registered in April. CPI data also came at 0.2%, lower than market expectations of 0.3%. Core inflation slowed to 0.6% from 0.7% in the previous month. This is fueling market rumors of fiscal stimulus to support growth. However, Caixin China PMI services rose to 57.1 in May from 56.4 in the previous month. Japan's GDP in first quarter of 2023 was revised sharply up to 2.7% from the preliminary estimates of 1.6% and market consensus 1.9%. This was on the back of capital expenditure and continued growth in private consumption. Capital expenditure increased by 1.4% in the first quarter of 2023, up from the earlier estimate of 0.9%. Though private consumption saw a modest decline from the previous estimate's 0.6% to 0.5%, it continued to grow for the fourth straight quarter. Zibun Bank Japan PMI services rose to 55.9 in May from 55.4 in the previous month. The World Bank expects global growth to slow significantly in the coming months amid high inflation, tight monetary policy, and more restrictive credit conditions. It expects global growth of 2.1% this year, down from 3.1% in 2022. It is an upward revision from a 1.7% forecast issued in January. On the other hand, OECD predicted global economy likely to expand by 2.7% in 2023, a slight increase from its previous projection of 2.6%. Growth expected to accelerate to 2.9% in 2024, unchanged from the OECD's March forecast. Now let's move to our next section, India News and Events. As per data published by Ministry of Rural Development, demand for rural jobs scheme increased in May. The households applying for work in the May was 31.7 million versus 22.3 million getting work. EV bill collection for May increased to 88.2 million, suggesting a higher GST collection in June. This data is also supported by previous week's PMI data that rose to 58.7 in May from the 57.2 in the previous month. This indicates strong industrial activities in the country. The World Bank retains its April forecasts for India's GDP growth at 6.3% for financial year 2024. It is expecting India's GDP to grow by 6.4% in financial year 2025 and pegs India to remain the fastest growing major economy in the world. India's services continue to be in expansionary phase as indicated by S&P Global India Services PMI Business Activity Index. The index rose to 61.2 in the month of May from 62.0 in the month of April. Now move to the next section, Market Analysis. Let's start first with USD INR price move analysis. During the week, USD INR traded in a band of 82.40 to 82.69. Currency pair is consolidating at these levels before making any decisive move. Last week was RBI's policy meet. RBI's policy decision of status quo was on expected lines. Now market participants are awaiting Fed's decision before start building fresh positions. Technically, charts are indicating consolidation and upward momentum is weakening. In daily charts, MACD are showing diversions and even RSI is also resisting the trend line. Similar move can also be gauged from weekly chart. On the upside, prices will be resisted at 82.85 zone. On the downside, first support zone is at 82.35. Break from those levels will take market to 82. Fed policy decision and commentary will decide the further move in the currency pair. Weak economic data from US is keeping a cap in the upside move in dollar index. Latest macro data from the US shows that factory orders rose by 0.4% month-on-month in April 2023. From the market expectation of 0.8% and slightly down from 0.6% in March 2023. In addition, the ISM Services Index also eased to 50.3 in May 2023 from 51.9 in April 2023, dragged by decline in new orders and employment. Employment data is giving initial signs of cooling labor market, which will put Fed on wait and watch mode. On the other hand, Eurozone Governing Council members are continuing to sound hawkish and in favor of rate hike to tame sticky inflation. This will continue to keep a check on rise in dollar index. Technically, there is a weakness in upside momentum in dollar index. In daily chart, It has broken support level of 103.64 and moving towards next support zone of 103.07, which is also a strong support in the weekly chart. Downside break from 103.07 will restart the down move in the index. However, we feel dollar index will consolidate at the current levels before making any decisive move. Large treasury supply to build treasury general account and fiscal financing along with monthly quantitative tightening of 90 billion US dollars will keep dollar index elevated. Last week, Saudi Arabia announced an additional voluntary oil production cut by 1 million barrels a day from July onwards to support falling oil prices in the market, which might extend into 2024. This led to surge in oil prices. However, weak economic data from US, Europe and China put a lid on price rise. We have seen a rise in Bloomberg Commodity Index in tandem with rise in oil prices. It is also contributed by the expectations of fiscal stimulus from China to support their economic growth. However, we believe any spike in the market will be short-lived on account of global growth concerns. Soft crude and commodity prices will be supportive for India's macro. Now let's discuss gold price move during the week and what lies ahead. Gold prices are consolidating at current levels before making any further move. Technically, correction is expected in the yellow metal, which is supported by the rhetoric from central banks to raise interest rates to tame sticky inflation. But global growth concerns are supporting gold. Back in India, demand is coming back at lower levels. Whenever gold prices moved around 1940 levels, we have seen strong demand. As understand from the market, jewelers in India are restocking inventories as and when prices are testing technical levels. Technically, 1940 to 1950 is a support zone. Convincing break of these levels will take the prices towards 1915 zone. On the upside, 1980 zone will continue to provide resistance. Now let's discuss price movement in equities. This week the most important development for an equity trader was RBI policy rate decision and inflation target guidelines. On Thursday, in the first 2 hours of trading, market was up by 50 points from the previous day. As soon as RBI policy rate decision to keep it unchanged trickled in, Nifty 50 started falling, finally closing the day with 0.5% fall. The sell-off was secular in nature and all sectors either fell or remained flat by Thursday trading close. The fall in the equity market continued on Friday with similar breadth and intensity. Not only RBI kept the policy interest rate unchanged, it expressed that inflation will be targeted more effectively to bring to 4% level. It is important to note here that RBI in tacit conjunction with Government of India in the past had adopted a policy of optimum long-time inflation at 4% for the Indian economy. However, keeping in mind different financial packages and benefits given to different sections of the population and industry post-COVID, RBI adopted a relaxed inflation targeting regime. It allowed itself a plus and minus 2% band, allowing the inflation to go up to 6% and down to 2%. Although in latest report, inflation is well below 6%, RBI made its intention clear that it wants to go back to its original target. The latter part of the declaration had possibly bigger punch, indicating that RBI will keep the policy rate unchanged for longer, till it achieves the inflation target. Though market was expecting rate pause and expecting the rate cut cycle to begin soon, governor's statement has pushed rate cut expectations farther. The market had a hidden desire for a rate cut cycle to start soon and expecting dovish stance from the policy, but MPC's hawkish stance was a bit of shocker. And this has happened on the back of approx 2 trillion Indian rupees or more excess liquidity in the system. Recent variable rate reverse repo auctions to suck up some liquidity was not successful. A keen observer of Indian equity market can make its own judgment from the above developments as to the near-term direction of Indian equity market. We interpret it as negative on a very short-term basis, spanning couple of days to a max of a week, ceteris paribus. Coming to Indian market pattern, one thing is obvious that sometimes around 23rd January 2023, Nifty 50 fell out of the rising channel and we interpret it as some kind of time correction. For last 12 weeks, market is in a rising channel and in spite of having two bad days post-policy rate declaration, the weekly candles have not broken down the support line. Upside resistance at 18,900 is still very intact. However, Bank Nifty has a slightly different story to tell. The weekly chart shows that although it is moving up hugging the lower boundary of the channel, from a long-term perspective, in the last 12 weeks, the rising channel has been broken on the downside, indicating possibility of a bigger fall. The third most significant sectoral index in Indian market is Nifty IT, representing software and allied services industry. Nifty IT is in a different trajectory altogether compared to Nifty 50 and Nifty Bank. From its January 2022 high, it could not resume its upward journey and going through the correction since then. Currently making sidewise move in a range-bound manner. In spite of several experts predicting Nifty IT to bounce back in recent past, it has been lackluster. This is indeed a worrying sign for Nifty. IT not only contributes 13% to Nifty 50's weight, but it also has lots of sentimental significance to Indian equity market. Now let's discuss price movement in government securities. During the week, 10-year government security traded in a band of 6.98 to 7.04 and it closed the week at 7.03 level. Hawkish tilt in the RBI policy pushed the yield higher. After the policy, we have seen 10-year GSEC yield has been hardened by 5 basis points as RBI has reiterated its focus on inflation to bring it back to its target level of 4%. As reported by Reuters, mutual funds sold bonds worth around 50 billion Indian rupees as the rate cut bets has been pushed forward. Technically, we see 10-year GSEC yields are moving towards 7.08% level, however 6.97% will provide support. After the policy announcement, we have seen the entire curve has moved upside. Movement in shorter tenor of the curve is due to RBI's liquidity operations to manage system liquidity through variable rate reverse repo auctions. Since RBI has continued to maintain withdrawal of accommodation stance, it will anchor overnight rates around repo rates. Further, ample liquidity in the system will refrain RBI to inject durable liquidity through OMO and CRR cut, as was expected earlier in the market. In the beginning of the week, lower than expected growth in factory orders and weakness in the ISIN services index led to rally in US Treasuries. However, rate hike by Bank of Canada and Reserve Bank of Australia rekindled inflation worries and led to rise in Treasury yields. We expect higher supplies along with inflation fear will continue to keep yields elevated. Technically 3.90 is a resistance zone. Upside break of 3.90 level will open the move towards 4.30. Treasury has started to rebuild its cash balances in the Treasury General Account, which rose by $29 billion to $77.5 billion. As per guidance from US Treasury Department, it plans to replenish the TGA to about $425 billion by the end of June, about $125 billion less than it had assumed previously. A slower initial rebuilding of the TGA could mean less upward pressure on lower end of the curve, which is also reflected in downward shift in the yield curve up to 1 year. Whereas larger supplies in the market to finance fiscal deficit will continue to put upward pressure on the yields. Here we wrap our discussions. Thank you for watching the video. If you have any suggestion or feedback, you can reach us at info@sahasacademy.com or visit our website www.sahasacademy.com. You can also reach us through social media platform LinkedIn, Facebook, Twitter and Instagram. To encourage us to share more videos, please subscribe to our channel. Thank you. Disclaimer: this video is made for educational purposes. It does not constitute an advice. Please consult with your investment advisor before taking any investment decision.